In just the last few minutes, the Federal Reserve has done something markets weren't fully prepared for. The headline number was exactly what everyone expected. Rates held steady. But the statement underneath that number didn't read like business as usual. And within seconds of its release, stocks turned lower, Treasury yields jumped, and gold gave back its gains for the day. In about 20 minutes, Kevin Warsh will walk out to face reporters for the very first time as Federal Reserve Chairman, and what he says next could decide whether gold finally breaks above $4,400 or whether today's hawkish surprise marks the start of a deeper pullback. By the end of this video, you'll understand exactly what changed in today's Fed statement, why markets reacted the way they did within seconds of its release, what to listen for the moment Warsh starts speaking, and which gold and silver price levels will tell you who actually won this afternoon, the hawks or the doves. Let's start with where the metals and the broader market stand right now in this brief window before the press conference begins. Gold opened today just above $43.50 an ounce and held close to that level through the morning, extending a 5-session winning streak built on optimism around the U.S.-Iran ceasefire. But the moment the Fed statement crossed the wires at 2 o'clock Eastern, that momentum stalled. Gold trimmed its intraday gains and is now trading essentially flat for the day, hovering in the $43.20 to $43.40 range, as traders digest a statement that struck a noticeably more hawkish tone than some had hoped for. That's an important tell. A genuinely dovish surprise would have sent gold sharply higher within seconds. Instead, the metal is sitting still, which tells you the market isn't yet convinced which way this afternoon ultimately breaks. Zoom out, and the bigger picture remains unchanged. Gold is still up close to 28% over the past year, even after pulling back from a record above $5,500 earlier this year during the worst of the fighting with Iran. Silver is behaving similarly, holding in the $70 to $71 zone after a sharp round trip from January's all-time high above $121. Chart watchers have flagged 70 to 72 as the pivotal area for silver right now. A clean break above 72 would open a path back toward $80, while a slide back under 60 would put the major accumulation zone down near 50 back in play. For now, it's caught in the same wait-and-see posture as gold. Outside the metals, the reaction has been sharper. The U.S. dollar index, which had been on the defensive most of the morning as Middle East tensions eased, firmed up immediately after the statement, with 99.50 acting as the key technical line traders are watching for the rest of the week. If the dollar settles convincingly above that level into the close, that's confirmation the market is leaning hawkish into the press conference. A fade back below it would suggest today's spike is more knee-jerk than conviction. Treasury yields jumped too. The 2-year yield rose roughly 11 basis points to 4.15%, and the 10-year added about 4 basis points to land near 4.47%, both signs that bond traders are pricing in less room for cuts than they were an hour ago. Stocks didn't like it either. The S&P 500 slipped about 0.6%, the Nasdaq fell around 0.7%, and the Dow gave back roughly 160 points, all within minutes of the release. It's worth noting that bond markets barely flinched when May's hot inflation reading came out a few weeks ago, since traders correctly read most of that increase as an energy story tied to the war rather than a demand-side problem. Today's reaction was sharper because this move came from the Fed's own language, not from a single data point investors could shrug off. Keep some context here too. The Dow only just closed above 52,000 for the first time in its history earlier this week, so today's modest pullback is happening from genuinely record territory, not from a market that was already on edge. So, what actually happened? The Federal Open Market Committee voted to hold its benchmark rate at 3.5 to 3.75%, exactly as roughly 97% of traders had expected heading in. That part was never really in doubt. What moved markets is that Kevin Warsh, in his very first meeting as chair, restructured the policy statement itself, and early reporting indicates the language that had previously hinted at additional rate adjustments down the road was stripped out entirely. That's the so-called easing bias, the wording that told markets the door remained open to further cuts. Removing it doesn't mean a hike is coming tomorrow, but it does mean the committee is no longer signaling that cuts are the default next move, and traders treated that shift as meaningfully hawkish. Alongside the statement, the Fed also released its quarterly summary of economic projections, the dot plot that shows where each policymaker expects rates to land by year-end. We're still parsing the full detail of that release, but the swift, synchronized move across stocks, bonds, and the dollar is consistent with a committee that has walked back the single rate cut it had projected back in March. Here's the backdrop that makes this shift make sense. May's consumer price index came in at 4.2% year over year, the hottest reading since April of 2023, with energy costs tied to the Iran conflict accounting for more than 60% of that monthly increase, according to the Bureau of Labor Statistics. Producer prices ran even hotter, up 6.5% year over year in May, a leading indicator that more pressure could still be working its way through the pipeline. At the same time, May's jobs report blew past expectations, with employers adding 172,000 positions, unemployment holding at 4.3%, and wages still climbing 3.4% over the past year. Put bluntly, there's no part of the data that gives a new Fed chair cover to sound dovish right now, no matter what his personal instincts on rates might be. And those instincts matter here because Kevin Warsh has spent years criticizing the Fed for moving too slowly on inflation in the past, and President Trump has made clear he trusts Warsh's judgment more than he trusted Jerome Powell's. Trump himself said ahead of today's meeting that he saw no reason for the Fed to ever raise rates, which makes a hawkish-leaning statement, under the very chair he handpicked, a genuinely notable moment, whether you read it as independence or as defiance. Warsh has also been openly skeptical of the dot plot itself, arguing publicly that locking individual officials into a quarterly forecast can tie the committee's hands when conditions shift quickly, and there's real speculation heading into today that he may have chosen not to submit a projection of his own, a largely symbolic move given how critical he's been of the exercise. If that's confirmed once the full release is parsed, it would say a lot about how differently he intends to communicate with markets going forward, regardless of where rates actually end up. He inherits a committee that's already fractured. Back in April, under Jerome Powell, the Fed's decision to hold rates produced 4 dissenting votes, the most since 1992, with several regional presidents pushing to drop the easing language even then, and the global backdrop only reinforces the hawkish drift. This same week, the Bank of Japan raised its own policy rate a quarter point to 1%, while the Reserve Bank of Australia held its benchmark at 4.35% after its own hawkish pause. Central banks around the world are leaning the same direction, even as the path for any single one of them stays genuinely uncertain. All of which is why the next half hour matters so much more than the statement that already crossed the wires. Gargi Chowdhury, BlackRock's chief investment and portfolio strategist for the Americas, put it well heading into today. How Warsh frames his answers matters more than the policy statement itself. Investors will be listening for whether he believes the Fed should look through energy and tariff-driven inflation as temporary noise, how he thinks about artificial intelligence and productivity as a disinflationary force, and whether he believes the so-called neutral interest rate has permanently moved higher. They'll also be watching closely for any hint about the future of forward guidance itself, given how openly critical Warsh has been of both the dot plot and the tradition of holding a press conference after every single meeting, a practice that's only existed since 2011 under Ben Bernanke. Now let's talk about the levels that will actually tell you who wins this afternoon. On gold, 43.50 is the immediate pivot, the same level the metal has been orbiting all week. Above that, the next real test sits around 4,400, which lines up with a key short-term moving average that's capped recent rallies. A clean break and hold above it opens the door toward 44.75 and then the psychologically important 4,500 mark. On the downside, there's an unfilled gap in the chart back near 42.20, and a more serious breakdown would put attention back on the $4,000 level, which has acted as a major line in the sand throughout this entire run. It's worth being honest about the technical backdrop too. On some chart measures, gold's shorter-term trend has crossed below its longer-term moving averages for the first time in years, a bearish signal that's tempering near-term enthusiasm even though the 12-month trend remains firmly higher. In other words, the structural bull case is intact, but the next few sessions could still be choppy. Silver's levels are simpler. 70 to 72 remains the zone to watch, with a break above 72 opening a path back toward $80 and a slide beneath 60 putting the $50 accumulation zone back in focus. On sentiment more broadly, this market remains genuinely split. The technical picture argues for caution in the near term, but the structural case, persistent central bank buying, rising investment demand out of markets like India, and at least one major Wall Street bank with a long-term target as high as $8,000 an ounce, keeps long-horizon investors holding on through the volatility. Today's press conference is shaping up to be the tiebreaker between those two camps, at least for the next few weeks. Looking ahead, the press conference itself is the headline event, and 4 things will tell you which way it's breaking in real time. How Warsh characterizes this bout of inflation as temporary noise from energy and tariffs, or as something stickier, whether he reinforces or softens the statement's already hawkish tone on future rate adjustments. Any language about the Fed's balance sheet where the word to listen for is recalibration, and how he discusses the dot plot's treatment of this year, since a median that simply removes the prior rate cut is the base case markets have braced for, while a median that adds an actual rate hike would be the real shock. Beyond today, keep watching for Friday's planned signing ceremony in Geneva on the broader US-Iran framework. Oil has already slipped under $80 a barrel on optimism around that deal, and a successful signing would keep easing the energy side of this inflation story, even as the Fed sounds tougher on the monetary side. From there, June's CPI report and the next jobs report, both landing in the first half of July, will be the next real tests of whether today's hawkish tone was the right call or an overreaction to a few hot months of data. Here's the bottom line. Today's rate decision changed nothing on its own, but the statement underneath it and the press conference about to begin are reshaping how markets think about Kevin Warsh's Fed for the rest of this year. Gold's muted reaction so far tells you this market hasn't picked a side yet, which means the next 30 minutes carry more weight than almost anything else investors will see this week. If you found this breakdown useful, hit subscribe and turn on notifications, because I'll be back the moment Warsh steps away from that podium with a full breakdown of exactly what he said and how gold, silver, and the dollar actually closed the day. Drop your own read in the comments. Do you think Warsh leans into the hawkish tone the statement just set, or does he try to soften it the moment reporters start asking questions? I'll go through as many of your predictions as I can in tomorrow's video. The headline number was never the story today. The next 30 minutes are, and markets are about to find out exactly what kind of chairman they're dealing with: hawk, dove, or something genuinely new that doesn't fit either label yet.